Imagine waking up one morning, checking your portfolio, and seeing red everywhere. Stocks plunging, news anchors shouting, investors panicking. The market is crashing. You feel that tight knot in your stomach, fear, uncertainty, maybe even regret. What should I do? Should I sell? Should I buy? Should I do anything? If you've ever felt that panic during a market crash or fear you might when the next one hits, this video is for you. Because today, we're going to talk about how to survive a stock market crash. Not just financially, but mentally too. And by the end of this video, you will understand exactly what smart investors do when everyone else is losing their minds. Let's start with a harsh truth. Market crashes are inevitable. They're not if events, they're when events. History shows that the stock market crashes roughly every 8 to 10 years, sometimes more frequently. Whether it's the Great Depression, the dot-com bust, the 2008 financial crisis, or the 2020 COVID crash, one pattern always repeats. Markets fall hard and then they recover even stronger. But here's what separates the winners from the losers. It's not about predicting the crash. It's about preparing for it. See, most people react emotionally. When stocks start to fall, fear takes over. They sell at the worst time, when prices are low, locking in their losses. Then, when the market finally recovers, they are too scared to get back in, missing the rebound. That's how investors lose money, not because the market crashed, but because they panicked. So how do you survive and even thrive during a crash? First, let us shift your mindset. A stock market crash isn't a disaster, it's a discount. Imagine walking into your favorite store and seeing a 40% off sign. Would you panic and run away? Of course not. You would grab everything you could afford. That's exactly how millionaires see a crash, as a sale on the world's best companies. When the average investor says, "I'm losing money," a seasoned investor says, "I'm buying opportunities." But let's be real, mindset alone isn't enough. You need a solid plan. So here are 5 powerful steps to help you survive and come out stronger from any stock market crash. Step 1, build an emergency fund before the crash happens. The biggest mistake investors make is having all their money in the market. When a crash hits and they need cash, they're forced to sell their investments, often at a loss. Don't make that mistake. Keep 3 to 6 months worth of living expenses in a savings account or liquid fund. That way, you will never need to touch your investments during a downturn. This cash cushion gives you peace of mind and the patience to ride out the storm. Step 2, don't check your portfolio every day. During a crash, the worst thing you can do is constantly refresh your investment app. Every dip will trigger anxiety and fear leads to bad decisions. Remember, market crashes feel catastrophic in the moment, but they are just blips in the long-term chart. If you zoom out to a 20-year timeline, every crash looks tiny compared to the growth that follows. So instead of obsessing daily, focus on the big picture. You're not investing for next week, you're investing for the next decade. Step 3, keep investing, even when it hurts. This is the hardest one emotionally, but the most powerful. When the market crashes, your instinct will scream, "Stop investing, wait until it is safe again." But that's exactly what most people do and why they miss the biggest gains. The truth? Crashes create the best buying opportunities. When prices fall, your regular investments, like through a 401k or index fund, buy more shares at cheaper prices. This is called dollar cost averaging, and it's one of the most effective long-term wealth strategies ever. So when everyone else is fearful, keep investing. You'll thank yourself later. Step 4, focus on quality and diversification. Not every stock survives a crash. Some go bankrupt, others take years to recover. That's why diversification is your shield. Don't put all your money into one company, one sector, or one country. Spread your investments across industries, index funds, and even asset classes like bonds or real estate. Diversification doesn't eliminate losses, but it reduces risk. And quality matters too. Blue chip companies with strong balance sheets, steady cash flow, and reliable products can weather any storm. Think Apple, Microsoft, Johnson & Johnson. Businesses that survive because people still need their products, even in a recession. Step 5, control what you can and ignore the noise. You can't control the market. You can't control inflation, interest rates, or what the Federal Reserve does. But you can control your behavior. You can control how much you save, how consistently you invest, and how disciplined you stay when fear spreads. Remember, financial media thrives on panic. Stock market collapse. Investors lose billions. Recession incoming. These headlines get clicks, not truth. Turn off the noise. Focus on your long-term plan. Because the only real danger is losing your patience, not your portfolio. Now, let's get something straight. Surviving a crash doesn't mean ignoring reality. If you are close to retirement, you may need to rebalance your portfolio towards safer assets. If you are heavily leveraged, it is time to cut debt. But for most long-term investors, the best thing to do during a crash is nothing. Yes, nothing. Sit tight, stay invested, and let the market heal. Because here's the data. If you had invested $10,000 in the S&P 500 in 2003 and left it untouched for 20 years, your money would have grown to over $65,000. But if you missed just the 10 best days, the days that often come right after a crash, your return would drop by nearly half. That's how powerful staying invested is. Timing the market doesn't work. Timing the market does. Now let's talk psychology, because during a crash, your emotions are your biggest enemy. Fear, panic, regret. These feelings are normal but dangerous. They make you forget your long-term goals. So what can you do? Remind yourself why you invested in the first place. If you're investing for retirement, you're not cashing out for 20 to 30 years. Do you really think this crash will still matter then? Probably not. Every crash in history, no matter how bad, has eventually led to new highs. The market rewards patience, not panic. Also, remember this, the economy and the stock market are not the same. Even when news looks bad, markets often recover before the headlines turn positive. So if you wait until everything feels safe, you will likely miss the recovery. Let's take a moment to think about history. In 2008, the global financial crisis wiped out trillions of dollars. People said it was the end of capitalism. Yet those who stayed invested doubled or tripled their money in the following decade. In 2020, when COVID-19 crashed the markets by 35%, fear took over again. But within months, markets bounced back to all-time highs. Every crash feels like the end of the world until it's not. So here's the real key to surviving a crash. Have a long-term plan before it happens. Know your risk tolerance, diversify, automate your investments, and build that emergency fund. Because when you are prepared, you will not react emotionally. You will stay calm when others panic. And that's how wealth is built, not during the booms, but in how you handle the busts. Let's end with this powerful truth. Market crashes don't destroy wealth, bad decisions do. If you stay invested, stay patient, and keep your emotions in check, you will not only survive a crash, you will come out stronger on the other side. So the next time you see red in your portfolio, take a deep breath and remember, you're not losing money, you're gaining opportunity. Because the people who make the most money in the market aren't the smartest or the fastest. They're the ones who stay calm when everyone else is losing their cool. If you found this video helpful, make sure to like, subscribe, and share it with someone who is worried about the next crash. Because the truth is, you can't control the storm, but you can learn how to sail through it. And those who stay steady when the market falls are the ones who rise the highest when it climbs again.